We're now recording. A lot of people are wanting to see the recording of this one, so I'm going to share my screen and show you our agenda. Is the agenda visible to you now? No. Okay, let's try that again. Share my screen and let's see. Show all windows. Is it visible now? Maybe I need a mechanic.
Floyd, you may actually have a two screen. So it may be actually not showing up on the screen.
Let me hit share screen again. Do you have the agenda?
Yes.
Sweet. Beautiful. This is our 109th meetup. We do 9 months out of the year. I think we're starting our 13th year. Welcome, everyone. We've got a lot of new people. It's exciting to have such a large group, and I think it's a testament to people's interest in leveraged ETFs and especially this dollar cost average strategy. You don't have to worry about stochastics. You don't have to worry about moving averages. You don't have to worry about Bollinger Bands. So we're going to describe that to you. First, let's talk about our disclaimer. If you're involved in any of the IBD meetups, we're doing this for educational purposes only. We're not making specific buy and sell recommendations, but talking about overall market strategy. Basically, the disclaimer says you're not going to blame anybody for your investment decisions. You're going to be a grown-up. Know that I'm an unpaid volunteer. I have a full-time job. I'm not licensed. I'm not a broker. I've had a lot of people say, would you manage my money for me, please? And I've always said, no, that's not what I do. So everyone take personal responsibility. But I'm really happy to have all the first timers here. Wonderful to have so many joining us. And just very briefly, because Eric is in Ohio, it's very late there right now. So for respect for his time, I just want to briefly show you that we're still, as of about an hour ago, we still have IBD has us uptrend under pressure. We've got 6 distribution days. Today was not too bad of a day, but the market has been very challenging for a long time now. What Eric has asked me to do is before we let him talk about his version 2.0, I'm going to show you version 1.0. Let's see if I can find that one and bring it up. I'm assuming that you can see a thing called leveraged ETFs.
Yes.
Okay. So leveraged ETFs, they've been around for maybe 12 to 15 years. There's quite a few leveraged ETFs out there. Leveraged ETFs are typically best for experienced investors. If you're fairly new to investing, before you get involved in leveraged ETFs, you may want to paper trade them a little bit or just go in with a small amount of money and set tight stops. There's dozens of leveraged ETFs. I typically invest almost exclusively in TQQQ, the triple NASDAQ, and SOXL, the triple semiconductor index. Occasionally, I'll trade TNA, the triple Russell. I've done a couple of others, but my main vehicle is TQQ and SOXL. Why do we want to be involved in TQQ? Has a compound annual growth rate of 47%, which means your money doubles more quickly than every 2 years. If you put $10,000 in 5 years, that becomes $68,000. 10 years, that becomes almost $500,000. So let's do the setup real quickly. Leveraged ETF buy and hold strategy. You just put a set dollar amount in every month, no matter what the market is doing. Eric is going to get into a variation of that with his version 2.0. So the setup is you're a long-term investor. You have money to invest, and I just picked a number like $1,000 a month. There's no way you'd figure out what the lowest cost is every single month on the closing price. If you could figure that out, that's the best you could possibly do. The worst you could possibly do is if you were unlucky enough each month, you buy at the highest closing price. A really simple way to do it and not worry about highs and lows. The last day of the month or the first day of the month, you put $1,000 into TQQ. You just do it every single month. So how does that turn out? These numbers are based on results of about 6 months ago. So if you had done this for 12 years, you would have put in $144,000. The green shaded areas, if you do the first day of the month, your compound annual growth rate is 42%, and you'd have $4 million. Okay. 10 years, same compound growth rate of 42%. Your 120,000 turns into almost $2 million, 1.8. 7 years, your compound annual growth rate is 43%. That's the green bars. The blue bar is if you paid the highest price every month. The orange bar is if you did the best price every month. The green bar is what we would do if we bought on that first day. 5 years, your compound annual growth rate, 44%, and your $60,000 becomes $216,000. One of the reasons I developed this is after I first rolled out my leveraged ETF stochastic strategy, I had several people contact me. They were trying to program stochastics with different software and couldn't match my numbers. I was frustrated. They were frustrated. And I had people saying, hey, I don't want to subscribe to Market Smith, or I don't want to study all these technical indicators. Do you have something simple for me? It dawned on me a few months ago. Let's see what would happen if we did a dollar cost average strategy. Here's the results. This is looking backwards. This is historical. Will Rogers says history doesn't repeat itself, but it sometimes rhymes. We don't know what the next 10 years will lead, but if you think America is going to be successful, we're going to have cures for diseases, people are going to invent new products, there's going to be more people like Elon Musk. If you think the country is going to continue to be successful, then Q will probably be successful. I use $60 as the net asset value. I got the $4 million after 12 years. If the net asset value was 30, like it is now, you'd have $2 million. TQQ was actually higher than $90 per share, and that account would have been worth $6 million. The conclusion is that there's potential for long-term market-beating investment performance with monthly dollar cost averaging, and probably take you all of 5 minutes a month to carry this out. I think it could be done. We're going to have Eric now talk to us about his version 2 to how to even do better than what I've shown you. I wanted to thank Bill O'Neill. He mentored me many years ago. Amy Smith, who's head of the Meetup groups. Does anyone have any burning questions for me before we turn it over to Eric? Just unmute yourself and ask a question.
As you have done the exercise for TQQ, have you also done the similar exercise for SOXL?
I have. I haven't published it, but I've done it personally, and I find that the SOXL performs very similarly, sometimes better. SOXL was on fire 2-3 years ago and was performing very well. I'm not prepared to present the results now, but the results are very impressive. I've tested FAS and I've tested TNA. TNA didn't work out as well. TNA performed about half as well. FAS was maybe 2/3 as well. SOXL was similar to TQQ. George, you had a question?
Yes, this is George and Elliot. I have two questions. On that previous slide, was that starting with $10,000 and then $1,000 per month?
No, this was starting with $0 and only putting in $1,000 a month. So at the end of the first year, you'd invested $12,000.
What is the status of the triple leverage and taking those away?
I called ProShares about a week ago, and they said no decision had been made yet. There's a lot of activity with the SEC and others on cryptocurrencies. They're expecting favorable results, but nothing's been announced yet by the federal government on any restrictions on leveraged ETF.
Thank you. So what would be the reason for them to do that? Are people complaining because they're losing?
I suspect that people that don't have this product are telling the SEC that this product is too risky and they'd rather buy the not leveraged ETFs. I'm not sure that's true. Somewhere out there is saying that guys like you and me don't understand the risk and we should be prevented from trading this. If that restriction goes in place, then only investors that could prove a high net worth and lots of trading experience would be allowed to trade. But so far, George, nothing's been decided.
Thank you.
Any other question before we jump over to Eric? Hearing no questions, and you see the agenda screen now?
Yes.
I've been talking to Eric now for a few months, and Eric got me an email, and he said, taking your system and I can do better. And I got home and said, what are you talking about? And he was right. He can do better. Eric works as a senior product manager for a Fortune 500 financial technology firm near Columbus, Ohio. Specializes in creating and managing data and analytic solutions for hundreds of customers around the globe. He holds a bachelor's degree in administration from, and I got to make sure I say this right, the Ohio State University. and a master's in organizational leadership from Findlay University. He's been an IBD subscriber since 2010. Member of our Anchorage IBD meetup since April 2022. We've been trading a lot of emails. Eric, it's your show. I'm going to stop sharing and give you rights here.
I think if you make him the co-host, that should work.
There should be a button on his screen that says share screen.
If Zoom is set up that way, then everybody can share.
I'll make you the host, Eric, and you can take over. Okay, go for it, Rick. I want to make sure I recorded your presentation because there's a lot of people. We've got 51 participants and we had 105 RSVPs. So like 50 people are going to see this by recording. So take it away, Eric.
So it's saying I'm disabled from screen sharing.
Let me see.
As I remember, there should be a couple of options. One is to make him co-host. The other would be to change the overall session option so that anybody could share screen. My share screen button is on, but when I hit it, it says host disabled, participant screen sharing. So there's an option in there somewhere. Matt, did you know where that is?
If I go up to Zoom and go to preferences, it should be in there somewhere.
In my meetings, I use the green button and there's an option there.
We never have a problem on my meeting. And I got 5-10 people every week share. But Zoom changes fairly regularly because I have problems. And Floyd, this might be something only you can see.
Let me see. Find Eric's name. When I click on the three little buttons, it says ask to start video, chat, make host, rename, allow to record multiple files, allow multiple pen, whatever that means, put in waiting room. So I
Allow multiple what?
allow, it says allow multiple pen.
Maybe that means people drawing on the screen.
Can you see a screen share button, Eric?
It's still saying it's disabled.
So why don't I just, Eric, I know this is real
Yeah,
numbers.
no problem.
Let me share the screen and I'll bring up your presentation. Can you guys see a presentation that says leveraged ETF?
No.
Okay. Let me hit share screen again.
Floyd, I made some update to that. Should I send you the new one?
Yes. Email it to me and we'll bring it up.
I just sent it.
Let me go to split screen then. And we'll get it together. Eric, your presentation is loading right now. Let's see. Go download. Here we go. Now I've got it in PowerPoint. Yeah, I believe this is the one, Eric. It's got a 2 after it. So I believe this is your updated one. So let me go back now and share screen and see if we can launch this puppy.
Okay.
Share screen. Okay. Okay, perfect. I think we have it together now from the beginning. Eric, I guess what you'll do then is just tell me when you want me to advance.
Okay. Go ahead and go to the next slide. All right. Floyd mentioned this already, but this is for educational purposes, not recommending anything to buy or sell. And this involves substantial risk. Let's go to the next slide. I wanted to talk about core concepts here. Floyd, if you want to hit the space bar 3 or 4 times, there you go. In How to Make Money in Stocks, Bill has a lot of great quotes, nuggets of wisdom. I'll read a few of them here. He talks about opportunities are out there for everyone. You're in a continually changing and improving new America. He continues at the bottom, talking about our system of freedom and opportunity, how it serves as a model of success for countries around the world. Below that, he talks about great opportunities occurring in America. Get yourself prepared, study, learn. You can do it. You just need determination to succeed. I think this is actually at the end of the book, around like page 492 or something. It says success is a free country is simple. Just get a job, education, learn to save and invest wisely. Anyone can do it. The point is when we're going through a dollar cost averaging strategy, this is something we want to stick with for 2, 3, 4, upwards of 8, 10, 12 years. There's going to be a lot of ups and downs, and I'll actually go through a lot of this within this presentation. But having these core concepts are necessary to get through and stay grounded through the whole process. Go to the next slide. All right, so Floyd alluded to this, but why do we want to trade TQQQ rather than some of the other technology ETFs? This is a graph since 2011 showing TQQQ alongside the Direxion product, which is their technology bull 3X, and the semiconductor bull 3X. And you can see that TQQQ in the blue has outperformed all of them pretty much since inception. So it's a pretty good track record. Let's go to the next slide. There's a lot of data on this. I wanted to go through all the declines and advances and what those look like. I'll start with the first row here. We had a start date for this decline of 11/22. This is actually the most recent decline. We made a local bottom recently in June on the 16th. That decline so far for the QQQ is around 34%. The TQQ decline is around 77%. If we took the QQQ and multiplied that by 3, we would actually arrive at 102%. But the TQQ only dropped 77%, which is still quite substantial. But the difference is 26%. If we go to the next decline, the COVID decline, it started on February 19th and made a bottom on March 23rd of 2020. On that one, the QQQ, you can see declined 31%. TQQ declined 73. If we take 31, I think this is a rounding thing. It should really be 93%, but it says 92. Nevertheless, it actually did 19% better than what a 3X QQQ should have done. And so I'm not going to belabor the point, but essentially you can see that the differences on that last column are all better. So all of the declines are actually less than what you would typically think would happen with a 3X QQQ product. Let's look at the advances now. The most recent advance, this is from the COVID low up to November 22nd of 2021. The QQQ advanced 148%, while the TQQ advanced 1,036%. If it were really a true 3X QQQ product, it should have only advanced 443%, but actually did 593% better. And you can see in that last column, pretty much every one of these advances were higher, in some cases, substantially higher, several 100% higher. We had one instance, and that was the flash crash. The QQQ and TQQ actually top and bottom within days and weeks of each other. I did make some notes, and when I was going through this, I didn't hold any punches. If the TQQ made a low and it was several days after the QQQ, I used the absolute low. I didn't use the day that the QQQ made a low. Make sure that I got the absolute bottoms and the absolute tops, and trying to make sure to get the right data. All right, so what's going on here? I'll try to explain this. Let's go to the next slide. Floyd's talked about this on this prospectus, but it bears repeating. It essentially, this product, the TQQ, it's really meant to see the daily results before fees and expenses correspond to 3x the return of the NASDAQ 100 index. This is important for a single day, not any other period. Let's go to the next slide. Let's go through a simple example here. So what I've done is I've got QQQ and TQ, and what we're going to do is 4 days in a row and a 5% drop each day. Okay, so we can see QQ and TQQ, they both start on day 0 at $100 a share. On day 1, QQ drops 5%. So that goes to 95, right? TQQ is going to drop 15%. So it drops to $85. Let's go to day 2. Q drops another 5%. That gets us to $90.25. TQQ drops another 15% off of the 85. That takes $72.25. Okay. And so day 3 and day 4, the same thing. If we follow it to the end, the total decline for the QQQ after we're all said and done comes to 19%, while the TQQ, that total decline comes to 48%. And go ahead and hit your space bar a couple more times, Floyd. Yeah, there you go. All right. So now let's talk about advances. Day 0, they're both at 100. And we're going to do a 5% gain each day. So QQQ, day 1, gains 5%. goes to 105. TQQ gains 15%, and then it goes to 115. Day 2, QQQ gains another 5%. It goes to 110.25. TQQ gains 15%, and it goes to 132.25. In the end, we wind up with an advance of 22% for QQQ, and TQQ winds up at 75%. As I said earlier on the last slide, this is really only supposed to correspond to a single day, right? And so that's what we did in this example. And this is exactly how these get so disconnected, because if you look at the decline in QQQ up above, it dropped 19%. That should have been nearly a 60% drop for TQQ over that 4-day period, but it wasn't. It was actually a 48% drop. The reason why that happens is because it's not supposed to correspond to multiple days. It's only corresponding to 1 day at a time. That's why those declines and advances happen that way. It's disjointed on these trends. And if the trend stays intact, it's just compounding each day more and more. All right, let's go to the next slide.
Good.
So let's talk about non-trending risk.
Rick, you got something urgent there?
I have another way to explain what he just showed too. As a math person, it makes sense to me. On the 5% where you're losing 5% a day, you're taking that 5% off the smaller number, and it's approaching a limit. The limit is 0. You can't go lower. You can't lose more than 100%. You get closer and closer to it, and it's going to take more and more time to build that up. If you're down to 10%, you have to make it 1,000% to get back to even.
Rick, you're ruining my presentation. That's exactly right, Rick. You're spot on. Now that Rick's told everyone the punchline, but let me keep going. Let's talk about non-trending risk here. If you hit your space bar a few times, Floyd, have a section highlighted. So right here on the perspectives, it talks about periods longer than a single day. The fund will lose money if the index's performance is flat. And it's possible that the fund will lose money even if the level of the index rises. This concept is called decay. And if we go to the next slide, I have another example here. Decay is caused by the volatile movement of an index going from up to down or down to up, resulting in a flat outcome. This is what Rick was alluding to. If you look at QQQ, day 0 starts at 100. Day 0, it starts at 100. On day 1, QQQ drops out of bed for whatever reason. Maybe there's a geopolitical event or something. It's down 10%. So that drops to 90. TQQ on that same day is going to drop 30%. So that's going to drop to 70. On the next day, let's say something happens and miraculously everything's resolved, and QQQ goes up now 11%. It's within 10 cents of its old high at 99.90. But TQQ has actually only gone up to 93.10, which is still almost 7% below where it started. This is a simple example of that decay factor that happens. Okay, go ahead and go to the next slide. Let's talk about real life examples. I alluded to this earlier with the flash crash. The QQQ made a high at 114.39. And obviously we had the flash crash in 2015, that waterfall decline that happened subsequently came up toward the end of the day. After a few weeks of trading, it made a new all-time high at 115.47, and it dropped again to 109, and then came right back up to that high again at 115.47. And if you go ahead and hit your space bar again, Floyd, this is TQQ in that same period. You can see it made its high at 128.78, had the flash crash, dropped down to 65.30. But as it came up, it actually did not make a new high alongside the QQQ, and it took a bit of time to actually get up there. This is just a real life example of that volatile movement and the fact that TQQ is not able to get back up to its all-time high. For these next few examples, I took all of the QQQ data and I did this daily 3x multiplier to simulate what would TQQ have done in March of 1999. Here's our hypothetical. We bought $1,000 of TQQ at the worst possible time. and we never added any more money. We put this $1,000 in, and this is exactly what happens. $1,000 rockets up within a year, almost sevenfold, and comes crashing back down, essentially about a 99% drop. So your $1,000 in 1999 turns into $1,097 today. What's the case for dollar cost averaging into a leveraged ETF? This is the exact same data set. The hypothetical is we bought $1,000 of TQQ at the worst possible time in March of 1999. And then we dollar cost average into TQQ each month on the first day. Each buy is equal to $1,000. That $1,000 becomes 10 million. $1,000 per month becomes 10 million. That was 280,000 contributed over a total of 23 years. Before you start running to your spouse or significant other saying you found the way to vast riches, I hate to throw cold water on this, but if you go to the next slide, we have a slight issue. So what's the catch? We have this little issue in 2000 where our account happens to drop. Go ahead and hit your space bar again, Floyd. We have these two drops. Would be very difficult to live through. And after you've rated your local CVS for all their Pepto-Bismol to get you through this, then you made the $10 million. But this is quite the drop that you would have to go through. Go ahead and hit your space bar again. The only thing I wanted to say on that last slide, just remember this slide because I'll come back to it toward the end. And I have some ideas on what could we have done to potentially get ourselves out of this, maybe sell some before the big drops. So let me stop there. Any questions? I just wanted to see if there's anything I could clear up before we move on.
This is George in LA. You did back testing in 99, but TQQ has been only around since 2010. Is that correct?
Yeah, that data, that's actually QQQ data, and I just applied a 3x multiplier each day.
Okay, I got it. Thank you.
Yep, no problem. All right, let's move forward. Let's get into this strategy 2.0. Floyd wanted one option, I'm giving you two, so you can pick which one you want to do. The first one is called buy more when down 30%. The second one is buy more in down months. I'll go through each one. And remember, what we're talking about here is a 4 to 8 year time horizon for any DCA strategy that you want to undertake. Go to the next slide. Here I am reading how to make money in stocks. And there's this little known chapter in the end that I don't think a whole lot of people read, but it's this one about making $1 million owning mutual funds. And Bill talks about in that chapter, dollar cost averaging. And gives us some tips on, hey, how could we do dollar cost averaging a little bit better? There's this blurb down at the bottom here. It says, how much do you think you would have if you also bought a little extra during every bear market of 6 to 12 months while the fund was temporarily down 30% or more from its peak? I decided to go back and look, since TQQ came out in 2010, what were the bear markets and how could I have added on to that dollar cost average strategy? All right, I'm using the QQQ monthly here to analyze where the bear markets are. In 2010, we had an 18% drop. By the way, I'm using the standard 20% drop in an index to qualify the bear market. So in 2010, we had this 18% drop. So that didn't quite qualify. We go to the next one, 2011, 2012, that was only a 17% drop. That one didn't qualify. We move up to 2015, there's the flash crash. That did drop 26%, but that was only a few hours. The next one, 2016, that was only an 18% drop. So I kept that as a red light. 2018, we had that bear market there. That was the kind of Christmas Eve Powell pivot. And we had the subsequent rally after that. I'll leave that as a yellow light. That actually did drop 24%, but really it was only like a couple days. Then it's been down there and then we bottomed and went right back up again. Now, the one here where you probably could have added was right around that COVID crash. We dropped quite substantially, 31%. You had quite a few days there where you could have added to a dollar cost average strategy. And then, of course, in the current market, you can see we're at a 34% drop. So that doesn't leave me a whole lot of options to add. So I went back to the drawing board again. If you go to the next slide, down at the bottom, it says, while the fund was temporarily down 30% more from its peak. So I went back to a TQQ. This is actually the strategy. Essentially, I'm going to buy more when it's down 30%. So the rule is you're going to buy more when the price of TQQ is 30% down from all-time highs at any time during the month. If we look at the chart, we can see that TQQ made a high at 73.36, and then it had this big substantial bar, this pink candle down, and we've got 30% down is at 51.35. You can see it traded below that during the month. If you were dollar cost averaging and make your buy at the end of the month or the first day of the next month, you would look at that bar. Is it 30% down from the high? Yes, it is. Then I'm going to buy more. You can see what's happening here. All these bars are 30% down. And it isn't until 6 buys later that it comes back up above that 51.35 mark. You're probably asking, okay, that's great. How much do I buy? I modeled it 2 different ways. You could buy double or 2x. If your standard monthly buy is 1,000, then you're going to buy 2,000. Or you can do 1.5x and buy 1,500. One of the things here that you have to recognize is on this strategy, a lot of these buys are going to come in clusters. And so that's what we have here on the chart. You can see you could have a cluster of 5, 6 buys in a row, and then you may not have another buy for another year and a half because there just isn't anything to do. And TQQ is in a big giant uptrend. It's just not dropping that 30% required. That's something to keep in mind with this strategy. Floyd provides 3 different strategies. So if you bought at the max price or the min price, the best price on the first day of the month, I just use the first day of the month to analyze. We can do a comparable because that's more realistic. If you look at the 12-year return, the first day price would have been around 4 million that you would have made over 12 years. But the down 30%, you would have actually made 5,383,000. The difference is 1,358,000 or 34% different. If you chose to do the $500 extra buy instead of the additional 1,000, that difference is 679,000 for a 17% difference. And every one of these strategies are coming in at better than the original dollar cost average strategy. All right, go to the next slide. This is the second strategy you could use. This one's called buy more in down months. The rule on this one is you're going to buy more of TQQ when the price is below last month's buy price. It's pretty simple. Buy more on a red candle. What you're going to do is you're just going to look at the chart. You get to the end of the month. When you make your buy or on the first day of the next month, you just look at the chart. Is the candle red? Yep, I'm going to make a buy. You see on the chart, I've got arrows on all of those red candles. That's where you would buy. Just add more on all those candles. And so there's 2 different options on this one. Again, it's buy double or 2x. So your buy would be 2,000 instead of 1,000, or you can do the 1.5x and your buy would be 1,500 instead of 1,000. I'd heard about this from Hans Overturf. He is the lead up meter at the San Francisco meetup. And I believe Hans uses this for his crypto trading when he's dollar cost averaging into Ethereum and Bitcoin. I just applied that same strategy onto this and it actually works out quite well. But yeah, thank you, Hans. All right, so let's go to the next slide. All right, so this chart here is going to analyze the regular dollar cost averaging versus the buy more on down months. At the bottom, you can see I've got that first day regular DCA, that 4 million, and our down month 2X actually makes over 12 years 5.6 million. So that is a difference of 1.6 million or 40% different. If you chose to do the 1.5x, the difference is 803,000 or 20% different. And you can see every one of these are also in the green and better than the original strategy. Okay, let's go to the next slide. Essentially, what I wanted to do was have one chart where you can see all of these strategies together. You can see up at the top on the bar graph, that first blue bar on the left, that's the original dollar cost average strategy. The next one is the 30% 2x. The one after that is 30% 1.5x. Then you have the down month strategy, which did a little bit better than the 30% 2x, and then the down month 1.5x. Go to the next slide. You're probably asking yourself, that's great, but how much extra money is this? Down here at the bottom, I have the number of buys needed for the down 30% 2x and the dollar amount needed for that strategy as well. Over 12 years, that one had 42 buys, would have costed you $42,000. If you chose to do the down 30% 1.5x, that would be 21,000. Then on the down month 2x, there were 56 buys. It would have cost $56,000. And then the last column, you can see if you chose the down month 1.5x would be 28,000. This is the number of buys for each strategy. What jumps off the page here, you can see with the down 30% strategy, those buys really come in clusters over a long period of time. You don't have as many buys with that strategy. Some people might like that. They may not want to have something where they have a ton of buys all the time. So that might appeal to them. Down 30%, you're roughly buying around 25% of the time. For the down month, it's actually quite a bit more, around 37% that you're buying more. Keep in mind, you can have down months even in pretty strong uptrends, and they can keep going. And so even when they're in an uptrend and you have a down month, you would simply buy more. That's how that would work. And if you hit your spacebar again, Floyd, I've tried to distill this down into this little grid here. If you have less time and less money, then maybe that 30% down 1x strategy would be right for you. It's going to be a lot less buys. It's going to be a lot less money. So maybe that's one you'd want to look at. If you have more money and more time, then yeah, I'd certainly go with that down month 2x. It's going to take a little bit more time because you're going to have to keep looking every month, see if that's a down month, and that's time to add. So on this grid here, what I did, I've got the down 30% at the top. So that tells you, again, we have the comparison of the standard dollar cost average, the down 30% 2x, the difference, and then the down 30% 1.5x, and then the difference for that as well. So you get the same columns. And then on the bottom, I added the buys and additional dollars needed. If you look at that down month 2x, which was really the best strategy, over 12 years, you put in $56,000, but you would have made 1.6 million. Floyd, in his email to me, said, we should just call this how to turn $56,000 into 1.6 million. You can use this to see exactly how much money it would take and what would have been the outcome if you had done the strategy. All right, if you want to go to the next slide. I've given a lot of data. I can pause here if there's any questions.
Are you only investing in those months when the market's down 30%? You're not making a regular monthly investment?
What do you mean regular monthly investment?
You're only adding to the TQQ in the months when it's down 30% from its high.
You make your regular dollar cost average buy, but you're only buying more on the months where it's down 30%.
That's what I wanted to clarify.
No problem.
I had two questions. One was when you showed the charts with the 3-year, the 18-month, the 3-year, the 5-year, are those the last 3 years and the last
Yes.
5 years and this year?
Yes.
If you can go back to the slide showing the graph of the 2022 downturn when it gets below 3 months, not this one, the previous one. Yeah, there you go. I got charts on my screen here. But those first couple of months you show, the market wasn't down 30% yet. I think it only hit 30% in May, but you would only start adding that extra money in May, right?
I'm not looking at the market at all. This is really just TQQ. And if TQQ is down 30% for the month, then I'm adding more.
TQQ was down 30% on that first month in January, that first big drop.
Eric, this is Roger in Anchorage. This is very intriguing. Just personally, what percent of your portfolio would you be invested in leveraged ETFs? In other words, if you had 100K, if you only wanted 6 to 10 equities, would you try to do all this with, say, 10 equities? You put 10K into the strategy over a year? Does that sound reasonable?
I can't give that kind of advice.
This is Bill O'Neill. You don't need 20 stocks, 20 equities. You only need heads.
I've been buying leveraged ETFs for at least 11 years, maybe 12. I started off pretty slow, and then I started doing all my back testing starting about 5 years ago. I eased my percent investing in leverage ETFs from 5% to 10% about 5 years ago. I'm up now to about 30% of my investment portfolios. I'm in leverage ETFs now about 30%, and I'm very comfortable doing that. For other people, that might be too much, but I have developed these rules, and so I have tight rules on using the stochastics, not this dollar cost average strategy. It's intriguing to me to think about how many people are going to get a $3,000 or $4,000 dividend check later this month, and their kids and grandkids are going to get dividend checks. And what I've been doing with non-leveraged ETFs with my grandkids, we put 50% in SPY and 50% in QQQ, and it's done very well. I'm tempted to put these little youngsters in some leverage money, but I haven't done it yet. So I don't know if that answers your question, Roger, but it gives a perspective of what I'm doing.
Yeah, I think you have to be realistic and start out with not as aggressive until you understand the strategies and you see some history. But it's interesting that you've been doing this for 11 years. Eric, how long have you been doing the investing in leverage ETFs?
Not very long. When we sent Floyd's presentations, I reached out to Floyd right after that. What was that, April, Floyd, or it might have been March or April that he did a presentation somewhere.
Yeah, I did one to the BAM group, I think about March or April. A year ago, I did the first presentation to the Molly group about maybe October, November last year. And then I did the BAM group. And then I did Boston was about May, I think. And then 2 weeks ago, the national IBD meetups, it might have been the BAM one that you heard, Eric. I'm not sure.
Just to play off of what Floyd was saying, I've actually done a ton of back testing with the strategy, with the stochastics. I've looked over all of Floyd's spreadsheets. I've looked at all the buys. I've tried to look in depth, like poke holes in everything. I can't poke any holes in it. I think a lot of it is you have to convince yourself. And the only way you're going to do that is by getting down and dirty with the data and looking at each buy and trying to figure it out. If that's something that you want to add more percent, then that's how you develop the conviction to take that from just a few percent to up to 10%.
I've done fairly well, not as well as I probably could have done if I'd understood it better. This year's market has been very tricky and interesting. And in the bear market, it's been fascinating to me.
So this is Floyd. The one thing I want to interject in full disclosure here is on the stochastic strategy, several really smart people that are computer programmers have tried to program the strategy outside of MarketSmith using other software, and some of them have hit challenges. It took us many months to even figure out how MarketSmith even calculates stochastics because it's non-conventional. We're lucky that a guy named Mike Scott got their hands on the MarketSmith code, and somewhere around line 400 or 450,000, I think Rajiv discovered. The nice thing I like about this dollar cost average strategy that Eric is talking about is you don't need moving average, you don't need Bollinger Bands, you don't need stochastics, you don't need Williams R, you don't need all of these indicators. If you believe that America is going to be successful, if you believe that innovators are going to invent products, if you believe that America has a future out there, one way to jump on the bandwagon, it will take you like 5 minutes a month to implement one of these strategies.
Excellent job, Eric.
Do you have more,
Yeah,
Eric?
I do, actually.
Any questions?
I have a question. This is Matt from Illinois. How much a month do you make on this strategy? Like, is it up 10% a month or is it up 8% a month? If you happen to average that out?
I just started this strategy last month, so I'm probably not a good person to ask.
Okay. Floyd, do you have anything?
I calculated the compound annual growth rate for, I think it was 3 year, 5 years, 7, 10, and 12. And all of those, no matter what the link enough, we've been in a bull market. I want everyone to think about this. It was March of 2003, I believe, when we had the turn. And so for the last 10 or 12 years, we've been in an incredible bull market. So we have to take this with a grain of salt. When I did the $1,000 a month only, no variation at all, the compound annual growth rate was somewhere between 40 and 50%. No matter if you went 3 years, 5 years, or 12 years, your money on average was doubling in less than 2 years on all of those strategies. But you have to just be careful. We were in an incredible bull market, but there are periods of drawdown, like the COVID crisis hit. With my strategy,
Would that equate to roughly a 5% increase a month? I was trying to break it down monthly.
I don't know the
And
answer.
the only reason I bring that up is because I can answer this other guy's question. My son trades. This is all he trades. His account is all in there. I figured out to trade for him to make 10% a month. It's very similar to what you were doing, and it works very well. You make 10% a month, and he's made 10%, and then 2-3 trades within a week and a half, and then the rest of the month you can do whatever you want. He's made it his own. And the last year, he didn't make any trades because, like I said, it was in a pretty big bull market for the first 6 months of the year. I was asking him one night, I said, "Hey, you been doing anything?" He's nothing's been presented. I'm like, okay, I get that. And in the second half of the year, he made 3 times what he makes at his job.
Does your son also trade?
No.
Okay.
It's only the TQQQ. I personally have tried the SQQQ. I'm not saying it won't work. I got it once. What you were saying with the stochastics, I was thinking about that. When we do eventually turn back into a bull market, is then when you have the downturns, maybe I'm going to try that. I always thought there was something there, but you have to be in it prior to the event happening. You have to see the down days coming for it to work, because it moves real quick and then you can't get in because you don't really make any money.
Anyone wants to see my presentation I made to the Boston group a few months ago, it includes how to trade with stochastics. If anyone would like to see that presentation, send me an email and I will send you the link. It's about an hour and a half long. It shows you how to trade stochastics on a daily chart. You're doing a trade on the average of every 2 weeks. I have a strategy using both the daily and weekly stochastics. If anyone wants to see that presentation, shoot me an email at tqqqinvestor@gmail.com, and I'll send you the link. Using MarketSmith, how I visually have gone through and picked out buy and sells. If that interests you, just shoot me an email.
That's a very good presentation.
Thank you. Go ahead.
Wanted to say to Matt, I was doing a quick little calculation there. You asked how much of a monthly percentage would a 40% annual be. It's about 2.8% per month. Compounded each month gets you to 40% in 1 year.
Oh, thank you, Rick. Sometimes the strategy will go up and give you 50 or 60%. But if you have a year or two in a row where you're making 50 or 60%, be ready for a downturn, which I think Eric is going to talk about, because when these things get outside of certain channel lines, they tend to correct. We all know if we've invested very long, the market has corrections, and we're in one right now.
What you're saying about Eric's plan buying when TQQQ is down 30%, we're doing lots of buying now. So it's 1, 2, 3, 7, 8. Is that 8 months? I think now we've been under 30%. And so that's lots, and the market's still going down. That's lots of buying without seeing any benefit. So that's a good test of fitness of your metal to stick with the plan.
Yeah. That will prove if you like this strategy or not. You ready to go?
All right. Yeah, go ahead.
Let me hit the advanced bar here.
So why would we be talking about dollar cost averaging? I know everyone's looked at the charts since 2009. We've been in this kind of epic bull market. Was there some kind of catalyst that we could look toward? It's interesting because I don't know how many of you attended the virtual IBD meetup, but John Pocoroba from the Boston meetup had an interesting slide, and I tried to collate some of that data here. He was talking about potential 13-year bull run on the horizon. And so these are just some stats he laid out. I've heard this from multiple places, other folks on Twitter and other places. But essentially, it comes down to there's 84 million millennials. It's actually the largest generation, larger than the baby boomers. These are folks born between 1981 and 1996. Recently, the oldest millennial turned 40. So they have around 15 years of peak consumption ahead. The boomers were 72.5 million. They were born between 1946 and 1964. Their peak consumption was around the 1980s to 2000. We all remember what that market was all about. And those same boomers are going to be needing healthcare, vacation homes, and they'll also be transferring wealth to millennials. These are possible catalysts for potential 10, 13-year bull run. If this happens, this kind of dollar cost averaging strategy could be highly beneficial. All right, go to the next slide. Let's talk about that. Go to the next slide. I have some thoughts on selling. Your dollar cost averaging every month, and you got to sell at some point, right? You got all these profits. You don't want it to just disappear on you. We have limited information on longer time frames with the TQQ, obviously came out in 2010. So for these examples, I'm using the QQQ and the NDX 100 to give some context around longer term. And if you go to the next bullet, Floyd, this first idea on selling is maybe you want to sell some when that monthly stochastic fast line falls below 40. You can see this is a monthly chart, and you can bring up stochastics on a monthly chart. When you're looking at a DCA strategy, you're buying every month. It's probably best off if you actually look at a monthly chart for the context for possibly when to sell. And so if you look up there, let's go back to around 2000 where that fast line drops below 40. You can see 40, I have it highlighted in black. It's that first line at the top, one above that, Floyd, right there. That's the 40 line. And so if you go over to the left, you can see that gray fast line. It drops below 40, right? It's been holding a support, drops below. That actually coincides quite close to the top. It's after it's made a top and peaked and starting to roll over. That could be a potential point where you could actually sell. You can see that stochastic kind of rolls over, hangs around below that 20 mark. And then around 2003, it pops back up again and winds up using the 40 line as support all through 2003 to 2007. You can see it drops below that 40 line. That coincides several months before the bigger drop. You have that initial drop, then it comes back up and taps the underside of that 40 stochastic line, and then it falls away from there. And you can see in the current market, we actually dropped below the 40 line just recently. So if you had been dollar cost averaging all this time, maybe when it dropped below that 40 line, that was a good time to maybe take some off the table. And when I say take some off the table, that's entirely up to you. Maybe that's 30%. It could be 25, 30, maybe upwards of 40 or 50%. That's something that you would have to figure out what makes sense in your situation. All right, so let's go to the next bullet point. The other one that I wanted to point out here is you can see this green line on the chart. That is the 12 simple moving average. And so the idea here is maybe you want to sell some when that 12 simple moving average begins the downtrend. It coincides with that 40 line, the fast line of the stochastic dropping below 40. Right after that 2000 top, you can see that green line starts to roll over. It's like starting a downtrend, probably a good time to get out. And you can see it in 2003, it comes back up and then it doesn't downtrend at all until 2007. So there's an additional sell signal. And then in 2009, we bottom out on the green simple moving average. And you can see the entire time, I can't find a downtrend in the entire run there since 2009. It goes flat for a little bit, but never really turns down except for recently. You can see that green line and turn down right there. Again, this may be a time where you want to take some off the table, figure out what's going on. Not saying you want to sell everything. If you've been dollar cost averaging for the 4 to 8 year time period, maybe that's the time to take some off. All right, let's go to the next slide. Okay, here's an additional sell signal. This is actually going back to the market top in late 1990s and 2000. We're using the index 100. This is what the QQQ is based off of. You can see this upper channel line that I've drawn. When I've done all of my back testing, I've found if that upper channel line, if you can get that to span roughly 2 years, makes it all the better. It's actually much more significant if you say. So right there in 1995, let's start there. You can see we've got a tap right there on that upper channel line. It does it again in late 96, 97, 98, and then again in 1999. From 95 to 99, that meets our 2-year requirement. You can see we hop over that upper channel line and use it as support. So you can see that was definitely a significant line there. And then we go in that massive climax run. Whenever you draw that upper channel line, your antenna should be heightened, right? You're looking for the climax. When can I get out? Maybe you saw a little bit when you're way up there over that upper channel line. Maybe you saw 2.5%, 5%, and maybe you saw a little bit every few months, like every 3 months. And then certainly you see where it breaks through that upper channel line. That also coincides with that fast stochastic dropping below 40 and the green moving average. They all converge together into one big sell signal right here that this is something significant. And maybe you need to step aside, take some profit off the table, and then reassess. And then you see again in 2003, we've got another upper channel line. It touches 2004, 2005, even into 2007. From 2003 to 2007, meets our roughly 2-year requirement. You can see it hops over that upper channel line again. Your antenna is up. You're looking at, okay, where's this going? Are we going into a climax run? You turn around and you just fall right through it. And again, that's another sell signal in that kind of time frame. Would have gotten you out long before the big precipitous drop that happened later on. All right, go to the next slide. This is the QQQ monthly recently. You can see here we have another upper channel line, and that one touches from 2010, 11, 12, 14, 15, 18, all the way, right? Clearly meets our 2-year requirement. We hop over it. Maybe this is the time where you want to think about, hey, I've been dollar cost averaging for 4, 5, 6 years. This is the time where I need to take some off the table. Let's reassess. So you can see we broke through that upper channel line and we're still stuck underneath it. That's another sell signal. Let's go to the next slide. This is a chart. I just wanted to put up, you can see I've got the regular dollar cost averaging versus the down 30% 2x and the down month 2x. So this is our main strategies. And you can see on a longer term chart, there isn't much difference between these. If we do get that catalyst of that 13-year bull run, it really doesn't matter what strategy you pick. You're going to wind up all the better in the end if it works out. This is really just to show you on a long-term chart that just pick a strategy and stick with it. Let's go to the next slide.
Top line 100 million or is that 10 million?
That's 10 million.
Okay.
All right. So this is my last slide. One thing to keep in mind, time is all relative. We all have 24 hours in a day. Doesn't matter if you're Elon Musk or you're Eric Ries or you're Floyd Dameron or any other person on this call. We all have 24 hours. All I can say is use your time wisely. And that's why I've given 3 dollar cost averaging strategies. If you're someone with no time, just use the standard dollar cost average strategy. It's like Floyd said, it's just a couple minutes every month. If you have a little bit of time, maybe think about that down 30% strategy. The buys are going to come in clusters and then they're probably not going to happen for a year and a half. So there might be long periods where you're doing nothing but your standard dollar cost averaging every month. If you have more time, consider that down month strategy. And I also touched on some selling considerations, things to keep in mind, maybe some red flags that you want to keep a lookout for, try to get you out with some profit before it all goes away. All right. And if you go to the next slide. So thank you to Floyd and all of the Anchorage IBD meetup. If you have any questions, that's my email.
Go ahead. Ask away.
Floyd, this is Rick. I just sent you a couple of messages directly in the chat.
I'm sorry, I wasn't paying attention.
If anyone else has questions.
Oh, there's all kinds of messages here. Wow. I hadn't been looking at any of them. Sorry, guys. Greetings from Ann Arbor. Barry's asking the question. Barry, if you're a member of the Anchorage IBD meetup, you'll get an email probably on Saturday with the recording. If you're not a member of the Anchorage IBD, send me an email and tell me you want the recording. Ken Smythe says it starts SQQQ. Eric?
My whole time has been devoted to this presentation and back testing.
If anyone is interested in SQQQ, is Dennis Wellborn, the meetup leader for the BAM group. That's the Bay Area Money Managers. So if you go to the Bay Area Money Managers meetup site, and email or send a message there. Dennis has a subscription service, and I believe he gives buy and sell alerts on leverage ETFs and also maybe even on SQQQ, but I don't trade SQQ myself. I'm trying to keep my life a little bit simple, and it's complex enough doing TQQ and stochastics, but I think there's an opportunity there for someone that wants to do some back testing and some strategies. So for Ken Smythe, I think it might be worthy of some back testing on that. Rick, it seems like we need to connect. I would like to connect with you, Rick. Let's hook up and we can do a Zoom meeting together.
That'd be great.
I'd like to do that. Let me write your name down, Rick. I don't know why we never did connect, Rick. Aren't you the guy that I referred a few people to?
Because I made the stochastic work and Thinkorswim working.
We'll do a Zoom meeting.
I only have your email address, so it's the only way I know to get hold of you. No, let's do that. That'd be great.
Those of you that want the recording, if you're a member of the Anchorage IBD Meetup group on Saturday, you'll get a link to the recording. If you're not, send me an email at tqqqinvestor@gmail.com and I will send you the link on Saturday. Excellent presentation. A lot of good kudos here. And if you want that old recording, Sylvia, tqqqinvestor@gmail.com. Tell me you want the Boston Meetup recording and I'll send it to you. Trader says, do you buy and sell TQQ based on just the stochastic cross? I have a series of rules that are in my presentation, but it's primarily based on stochastics, and I don't pay attention to if IBD says we're in a confirmed uptrend or uptrend under pressure. I look at the stochastic lines to make my buy and sell decisions on my TQQ trades to answer the question from Trader. So a lot of notes of appreciation here, Eric. It was an excellent presentation. You put a lot of time and effort into it. It really shows through with the quality of the presentation. Eric has provided his email address. After you've watched the recording or thought about this for a while, Eric has set up a separate email account and he's open to taking your questions. You can send questions to me. My theory is we're all in this together and blessed by the opportunity with the U.S. stock market. And we have computers, we've got brain power. God has given us talents that we can use, and we can use them wisely. And if we have appropriate buy and sell rules, I think we can be good stewards of our money. And then if you make money, then you can go out and do good in the world and you can help family and other people and help make it a better world out there. So any last questions before we sign off? We've gone quite a long time, and I know for many of you, it's way past bedtime, so be careful out there.
I was trying to find the Bay Area Investor Meetup group that you mentioned. I'm trying to do a search on Meetup, but I'm not finding it.
I think if you go to meetup.com/BA, no, excuse me, think about this for a minute. Oh, BAMM-IBD. That's Joe.
Management.
Yes. The Eric presentation, was that a buy and hold all that time? With that sell strategies along with dollar cost averaging?
Part of his presentation,
Yeah, it was just dollar cost averaging, but dollar cost averaging is based on the whole random walk thing where we're not supposed to know where the indexes are going. But we're all technicians. We know how to read charts. It's not that difficult. I was trying to inject some analysis simply to say, hey, you're dollar cost averaging, right? You're not going to want to hold TQQ. That was my point, right? In March of 1999, your $1,000 gets decimated. That was really the point. You got to take some profits off at some point. We're holding this leveraged ETF that has decay. I pointed out all of the intricacies of, hey, when it's trending up, it really trends up, right? You're going to get many hundreds of % more in a very strong uptrend. But when you get into volatile markets or when you get into a decline, yeah, that's the time where you want to be alerted to that. You want to be able to take some off the table. So hopefully that answers your question.
Gerald, if you work for a company that has a 401k and they're taking money out of every check and you're throwing that money into a mutual fund and you're going to work for that company for 20 or 30 years and you're hoping at the end of 30 years, one strategy with the dollar cost average strategy is no matter what's going on, you put whether it's 100, 500, or 1,000, you pick some amount and you put it in every single month, come hell or high water, with the idea of it's going to be 10 or 20 or 30 years when you either want to retire, put a kid through college, or whatever a life goal is. But we're pretty smart people here. I think what Eric's main point is pay attention to what's going on to the market. If you decide you want to sell some of your holdings, you need two rules. When am I going to get out? When am I going to get back in? During the COVID crisis, how many millions of Americans decided to go to cash? And they stayed in cash from April to the end of the year. We had the most incredible V-shaped recovery in the history of mankind. TQQ in 115 days went up 444%. And those people sitting on cash missed that entire run. So if that helps you a little bit. In the dollar cost strategy that I presented, it was hold the entire time and you accept the drawdowns, because the nice thing about the dollar cost strategy is when the price is lower, each month you're buying more shares. And the nice thing about buying more shares is when the thing finally recovers and takes off, you were buying those bargain basement shares. And when the thing takes off, those are worth 5 or 10 times what you paid for them. But you have to have a long time horizon. No one should be involved in this if you're going to need your money in 2 or 3 years, because we don't know what's going to happen in 2 or 3 years. And it should be money that if you need to hold it to recover, it's not going to drastically affect your lifestyle.
I saw you for the first time at the national meetup, the
Yeah.
IBD. I had Marcus Smith. I was doing the Stochastics with different strategies with stocks as well as ETFs. The XPI, I was
Cool.
using the biotech one too.
Is it working for you, or is it too early to know?
Everything's just green right now.
Any other questions out there? Because I think Eric is more than open.
I'll stay as long as you need me to.
Eric's wife put him down in the basement.
Yeah, I'm in the basement. She's got to get up at 5:30 in the morning. It's 12:45 here, so I need to go somewhere
see-
that I wasn't interrupting people.
Let's see if anyone, Matt Solomon, I might want to talk to your son and see how he's doing, and maybe we can connect up sometime. If he's trading in this stuff,
I'd be more than willing to. I'll ask him. He works nights. He should be home soon. Hopefully. I was surprised. I only found out when we were doing taxes, because we buy TurboTax. He was moaning about how much money he had to give. We live in Illinois,
Yeah.
and because the election's coming, the governor sent him a rebate saying, "Oh, you overpaid." I told him they're just trying to buy your vote.
so my father-in-law was an Alaska king crab fisherman, and his boat was actually on the series called The Deadliest Catch. My father-in-law was doing his taxes, and he was just moaning and griping. I said, Claire, I will give you my gross payment if you give me how much you gave the IRS. And he goes, no, that wouldn't be a good deal.
I'll talk to him sometimes. I don't know how he does it, but he seems to pick numbers and he'll buy. I remember one year, maybe about 5 years ago, he home from work and he didn't actually leave yet. It was a horrible day in the market. The market just crashed. Then I said, what are you doing? And he's, oh, did you buy today? And I'm like, no. And he was like, oh yeah, I bought. The big part about it is you got to have some balls about it. And what I figured out was all just based on looking at the IDDs, the market outlook, and just distribution days. We can all feel them when they're happening. Want to buy at the end of the day.
Yeah,
2, 3 days, you sell. That's the easy method, basically 10% a month.
What
Some
else?
other rules that go with it.
Anybody else have any questions before we let Eric get to bed? Eric, much
Yes,
appreciation. Got a question out there?
Are you in TQQ right now?
In one of my accounts, I'm in cash.
I just looked at the stochastics and it looks like you got a signal to get in. That's what I'm seeing.
Let's get out of this presentation and let me bring up.
Yeah, I think on the daily, you had a.
You got a stochastic, but the weekly's not turned yet.
I want to look at the weekly to see if it's turns. Can you see Marcus Smith?
Yes, of course. This is in your screen.
Are you talking about TQQQ?
Yes.
The daily,
Just
right,
crossed.
the daily is just now about roughly at 10, because I have a rule. You wait until it hits over 10, but the weekly has not turned positive yet. So if you're following the daily strategy only, you may have had that may or may not be a buy. It looks like it might be a buy signal today. On the weekly, if you're using the daily weekly strategy, you have to wait until this stops going down before you have a confirmation buy signal. So if you're more aggressive investor and you don't mind doing on an average of 2 trades a month, you would be jumping in now. So let's take a look at SOXL real quick. SOXL is not yet at a buy signal. Let's look at the TNA. TNA looks like a buy signal, and let's look at FAS. Wow, FAS went up 5% today. FAS on the daily, a buy signal, but on the weekly, you got a confirmation on the weekly on FAS today. So everyone see what I'm doing here?
Yeah.
Okay. So let's look at UPRO. UPRO might be right at about the 10% line. Let's look at the weekly. UPRO is still going down. One that is not heavily traded, but one that moves a lot is NAIL. That's the housing times 3. NAIL on the weekly has not got a buy signal. NAIL on the daily might have hit a buy today. And so that's just a few examples of things that I look at every single day. There's an 87% chance that on September 21st, the Fed's going to raise rates another 75 basis points. The rumor is either in October or November, they're going to raise another 50 basis points. And so when you have a market where the Fed is raising interest rates, it is challenging for the market to start a new bull market. So just be aware that we're in a interesting period. But if you're following the TQQ strategy, you don't pay attention to the news. You just look at the charts and let the charts tell you what to do. Okay, any other comments or questions?
I have a question for Eric.
Sure, go ahead.
If I'm using the down month strategy, I want to get this straight. Let's say August was a down month. So if August is a down month, then I would, in say the beginning of September, double up on my contribution. Instead of 1,000, maybe contribute 2,000. Is that correct?
That's correct.
Just wanted to clarify.
At the monthly chart, and if the bar is pink, you double up. If the bar is blue, you don't double up.
Yes.
Okay. So you just look at the monthly chart. If you use a market smith, the bars are either blue or red. And if it's red, that's when you double up.
Okay.
That's what I'm saying. It takes 5 minutes a month. It does take some courage, but the ideal time to start a dollar cost average strategy, it's much better now than starting it at a market top anyway. So if you look at the chart in front of you, that tall blue bar is probably like last November. And now it's much more advantageous to start the strategy than it was 6-8 months ago. I'm not trying to tell you the market can't go lower, because it can. But when the market turns around, the shares you're buying now will look pretty to you. If TQQ is hitting 60, 70, 80, 90 or higher, the shares you're buying at 25, 30, 35 are going to look very good to you.
I didn't specifically say that was what I was alluding to with when I brought up catalyst for the 13-year bull run and then all the sell signals. Just keep in mind, last time we got those sell signals was way back in 2007, 2008. So this is the first time since then that we got all those sell signals.
Yeah, let's bring up a monthly chart on TQQQ. So here's the monthly chart with monthly stochastics. According to Eric's calculations, about 37% of these bars are pink or red. So in round numbers, roughly a third of the time you're doubling up. We have a little cluster of those now. And there was a little cluster of them over here in 2018 and a little bit of a cluster over here. So occasionally you get the cluster. If you hold down the control button, you can draw a trend line like this on Market Smith. If this truly is an accurate trend line, at some point this baby is going to turn up and it'll be higher than the trend line. So that's what our belief is in the strength of America and the free enterprise system, that these things go through cycles. We happen to be in a little bit of a down cycle right now. Eric?
Yep, I agree. Just for full disclosure, I'm in TQQ. I'm following the same strategy that I'm laying out for you. So I'm not doing any kind of special thing that's secretive or anything. That's exactly what I've laid out.
Okay, everyone. I really appreciate the great questions. Thank you again, Eric. A tremendous presentation. Those of you that are Anchorage members, I'll send out the recording link. If you're not an Anchorage member and you want it, TQQQ investor@gmail.com, and just say, please send recording of Eric's presentation, and I promise I'll get it out.
Thanks, Floyd. That was a good presentation.
I think Eric had fun putting it together. It's a lot of work, but things start clicking in your mind when you start looking at charts and spreadsheets and you go, wow, I think there really is something here, and let's share it with the world. That was my philosophy. Amy Smith heard I was doing this and said, you have to present this to the group. And I said, are you sure? And she goes, yes.
I wasn't going to do it. Floyd prodded me to do it. And this is the first time I've ever presented to any IBD meetup group. It's funny, if you would have told me that, hey, your first presentation to an IBD meetup group is going to be around dollar cost averaging, I would have said, you're crazy. There's no way that would be allowed in an IBD meetup, but here we are. I just want to say thank you to everyone. Appreciate your time and attention. And you have my email on that presentation. I'm sure Floyd will get that out. If you have any questions, feel free to reach out. I'd be happy to connect with you.
Everyone have a great fall. Be safe out there. Better market days are ahead, I promise.
Eric, thank you. You did an excellent job for your first time.
Thank you for being part of the group, and we'll meet again on October 13th. I don't know what the presentation will be right now. If anybody here would like to be a speaker at an Anchorage meetup, send me an email and let me know what you would like to present. If I think it's interesting to the group, I'd be more than happy to have you as a guest speaker. Thanks, everyone, and good evening.
Hey, Floyd,
Yes.
does seasonality disturb you at all? That September is traditionally a bad month?
Yes.
It
So-
bothers me tremendously.
September, October typically are weaker months, but it's setting us up for a beautiful November, December typically. We have a very major event happening in November. Do you know what that is?
Elections.
Midterm elections. And I'm not trying to make a political statement, so forgive me if anyone thinks I am, but if the Republicans take either the House or the Senate, or if they were to take both, the market probably will respond favorably and go up. If the Republicans don't take one or the other, then the market may see some more down days ahead. Typically, if the president's a Democrat, whoever is the president loses some of the seats. That's just the way it works. It doesn't matter if you're Republican or Democrat. Wall Street likes, if all the power is not in one party, that means less legislation can be passed and less things for business to worry about.
One of the things that concerns me is that interest rates are projected to continue. I took a major hit on Jackson Hole. I just wish I'd gotten out of the market before Jackson Hole, but I didn't get the seriousness of it. And if you compound the seasonality and interest rates, you've got very serious headwinds. It's got me really concerned.
No, I think there are reasons to be concerned. IBD has us in a trend under pressure. And if we have a really serious additional down days, I could see IBD going to
Correction.
marketing correction. So I don't know if you ever watch IBD Live, Monica, but
I do every day.
those guys are saying that they're mostly in cash right now. The guys that are really smart on this IBD stuff, they're nervous. They've got a lot of cash.
I just discontinued my swing trader a day ago. I got disgusted with swing trader and they had no tickers. Everything they were putting on, they were taking off. They put it on and go whoops, put it on and go whoops. If you follow swing trader blindly, you would have just gotten chopped up like crazy.
Most of the trades lately have been losing trades.
It's almost like he's putting something up there just to do it. And then he says, whoops.
I think you're right. Plus, the market has just been down.
I didn't understand why they bought TQQQ right below the 50-day, and then it didn't go through the 50-day. The double leverage at PY, again, right below the 50-day, and it hasn't gone anywhere. Yeah. It was QID.
So they took a haircut. They ended up doing okay, but lost money on they put BJ on. Next day, it was an expectation breaker and lost money. Then it worked out after he had told them.
So they're swing traders. They have Archer, Daniel Midland, and TAN, which is the solar ETF, and ProShares Ultra P500, which I think is the S&P times 2.
Yeah.
So I'm surprised they put on SSO and not UPRO the 3 times. It seems like if you're going to go leverage, why not? Anyway, they went 2 times instead of 3 times. I think 2 days ago, there were 0 names on swing trader, and now there's 3.
I cut it off 2 days ago because I got so mad. And also what made me so mad at Justin Nelson was he was on IBD Live bragging that he's up 50% on Shockwave. And he didn't tell us to get in it.
Do you get the newspaper?
Yeah, I get the newspaper.
Then
The Shockwave thing. Why wasn't it on Swing Trader for us to buy?
I think because they try and be safe on Swing Trader, to tell you the truth.
On IBD Live, they were mentioning Shockwave almost every day about a month ago. I think a lot of us have some level of frustration. The market is called the great humiliator. We just have to have our rules, stick to our rules. And if the rules aren't working, find new rules and support each other in meetup groups. We share things so that when it's all said and done, we are comfortable making trades. Our account is hopefully higher than it was at the beginning.
But what bothered me is that he was bragging he had made 50% profit on the Shockwave, but it wasn't on Swing Trader. That bothered me.
Okay.
Yeah, I understand that, Monica.
Yeah, Floyd, I'm just curious. How about the experience with Leaders Board? Does team individuals in this call, they have somewhat different experience with leaderboard than the swing trader?
I've been in both for at least 3 years at the exact same time, and leaderboard is writer.
I tend to find leaderboard, first off, swing trader is for someone that only wants to hold something for, say, 2 to 10 days or 1 or 2 weeks, whereas leaderboard is more, I won't say long-term investing because IBD is not long-term investing, but swing trader is the short-term in and out, take a few percent profit and scale out. And the leaderboard is more trying to catch the momentum of growth stocks that you'll write up. And then when they go up 25%, if they do, you sell half of it or sell all of it and you look for the next opportunity. And so the nice thing about leaderboard is I think leaderboard right now probably has at least a dozen names. So right now it looks like they have about 8 names.
You get the same ones as you do on Swing Trader. The other thing I want to point out to Ashish is this. There's 2 other big flaws with Swing Trader that make me upset. And one of them is that it's really rigged with those bots. If you get a push notification, let's say you have nothing to do but trade, enter a trade as soon as you get the push notification. And that would mean you don't have time to look at it yourself and make your own decision. But let's say you just go with Swing Trader and go, oh, Justin Nielsen, he's so smart. I'm going to do it too. And you try to get in. If you don't have a quick clicker on your broker, like it takes a few steps like I do, by the time that you get in, the stock has already gone way up. And that's when the day traders are selling it because there are programs that get in super fast at computer speed automatically when it goes on Swing Trader. And then when everybody piles in and it goes up a little bit, they sell. If you wait about an hour, 2 hours, or 3 hours after all the day traders have sold out of it, you're going to get a better price.
If you put it in a market order or a limit order,
it all depends how excited I am about the trade, but I do limit orders often. So it's definitely something I have a strong skill in. Sometimes I say there's a Swing Trader effect that when he puts it on Swing Trader, it goes up right away a lot. It doesn't mean he's so smart. It just means that a lot of people are getting in with Swing Trader, sell it right after it goes up.
Now, I'm looking at the leaders list. There's more than a dozen names on this list.
But when he's in, doesn't mean you should get.
If you want to look at the charts, some of these may potentially be worthy of buying. So this limited list right here are the leaders near a buy point, but they also have a leaders list, which has 3 more stocks, and they have a leaders watch list, which has 3 more stocks.
Ken Shreve has said that when he puts leaders near a buy point, it doesn't mean he's recommending you buy them. He just means it's showing they're near a buy point. There's nothing like he's even saying this is a strong stock. He's just saying if they're a buy point.
But here's Double Verity Holdings, for example, and you can see we had about 6 blue bars in a row. relative strength line is turning way up. Earnings per share rating 90, timeless rating B, accumulation distribution A. This is pretty interesting to me right there. Look at their last.
I took a loss on that stock just now before it turned up.
Do you have pattern recognition, Floyd?
Yes.
It's not showing any pattern here.
Let's
See that orange
if I take
little
stochastics
symbol? Click on that. That should just turn it on and off. It's not showing any pattern here, so it's not breaking out.
a little bit.
I look at the homepage on MarketSmith every day, and on the bottom they have the stocks near buy point. They almost never trigger,
It seems like
or if they go past, they go in light volume.
If you were to take leaderboard as a recommendation, which I know nobody's recommending anything, we understand it's educational purposes only. But if you were to take it as a recommendation, my understanding is that the ones that are in position is what they're recommending. And if it says leaders near a buy point, it means nada. It doesn't mean a darn thing. It means that they're near a buy point, big whoop. That's all it
Right.
means.
Then you need to follow the chart.
Right,
For
right.
breakout, you want 40% more average volume. You want to see the positives.
So here's an example. Albermara's got a cup with handle.
Yeah, there you go.
It had a really strong day today, up 4% today, probably up 4% yesterday. And so this blue area is the buy zone, supposedly. So the ideal buy point was 273.78. And we're above that now. So I think this blue bar represents 5% higher than the ideal buy points. We just got out of the blue zone today.
I was losing my last $200 of profit.
You can see it broke out and it came up. It came down. It came up. Stop loss.
There,
It's tough because almost everything's doing that.
but did not hold it because I felt like I was losing my last $200 worth of profit.
Those lithium
Sorry.
plays are really shaky.
This looks nice.
Look at Chipotle. I think it had a good day today.
The Scholastics look great.
When Ken Shreve was telling everybody to take stuff off, we got these push notifications like, boom, sell stuff on leaderboard, and it went down to 4 stocks. If you did that, you really took losses, and now he's got everybody coming back in.
Folks, I really appreciate the conversation, but I think it's time to let some guys get some sleep here because the market opens in about 8 hours.
The futures are up pretty good right now.
Aha.
I trade futures. I watch Bloomberg just to see. And okay, we got to wait. We're looking at money. I think the Dow is up almost 180. Hang on a second. It'll come around. I'll tell you what. But we're looking pretty good if it holds. A lot of times it does not hold through the night.
Nasdaq is up about 70 plus point and Dow is about 100 plus.
Still on Bitcoin.
At 18.
There we
on
go. 16 and 74 for the NAS.
Everybody have a fantastic evening, fantastic fall. God's blessings to everybody. Thank you.
Thank you, Floyd.
First class, Eric,
Thank you, Eric.
Sorry, Floyd.
Monica.
I'm sorry, but you're right. I pushed too hard. Thank you.
I'm with you, Monica.
Great, Floyd. This is Rick.
Thank you.
For another great presentation, and let's connect.
Just shoot me an email and we'll do a Zoom call.
Yeah, sounds good. I've done a lot of analysis on this, so I'd love to share it with you.